Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ritu Singh, looking phenomenal for the markets. If you're a bull right now, it's up around 170 points at the day's high for the frontline index, the Nifty. More importantly, led by good news coming in from the globe, good news coming in from Asia, the Japanese market's doing well, and good news led by earnings. So we have good beats coming in from most of those players, including the likes of SBI, which is the top Nifty gainer. Ritu will speak a lot more about that. But look at the broader markets as well. Crompton, we have Kalyan Jewellers, all of them doing extremely well, which is firmly reflected in the kind of advanced decline ratio our market breadth is showing. So if you're a bull, it's a fairly good looking screen this Monday morning. Hi, Ritu.
Hi, Mangalam. Very good looking screen this Monday morning. A good start to the week as well. Nearly everything, if you look at the indices, is in the green. The FMCG pack, a bit of a mild red. Perhaps you could tell us more about it. But yes, numbers like SBI, uplifting sentiments, add to the fact that there is more clarity on the US trade deal. Some of the details emerging, that has got the markets upbeat. So look at, some of the top gainers. State Bank of India, of course, the top Nifty gainer in terms of volume-led buzzers as well. SBI is the top name out there. It's actually at a 52-week high as we speak. Apart from it, Hindalco, Shriram Finance, Titan, all of these doing well in trade today. But we're going to focus on some of the earnings that have come in. Apart from SBI, of course, there is Sonata Software, which is trading flat despite having a good third quarter. So we'll get chatting with the management in just a bit. But meanwhile, Mangalam, from the FMCG pack, if you could tell us, what seems to be bothering the street, not participating in the rally that we're seeing?
Well, the fact that they were resilient in all of last week after a decent performance coming in and the markets were volatile, maybe doesn't hurt to take some profits off the table. And at the same time, ITC, that's the one which is down about 1%, has a fair weight on the index. On Friday's trading session, there was a big move that we saw in the stock on account of big price moves that, the street was expecting and that came by on the cigarette prices. And right now, as we speak, there have been a bunch of brokerage notes that say that maybe the prices have not been enough to cover the entire tax increase on tobacco. So maybe there could be a bit of a hit on the EBIT performance in the next couple of quarters. So that's something that the street will be monitoring as we move ahead. But sparkling quarter coming in for Kalyan Jewellers. No, concerns around that one. The street was prepared for a good performance, but the company's gone ahead and reported an even better set. 42% jump in the revenue is what the company has reported. And a large part of that has been led by same-store sales growth of 27%. That's, also shown in the EBITDA, which is up almost 75% from 430 crores all the way up to 750 crores. And the margin expansion obviously looks a lot more protruded, largely because the same time last quarter, we had a bit of an exceptional in terms of a loss coming in on the customs duty reduction on gold as well. And the net profit up nearly 2 times from 218 crores all the way up to 416 crores. The non-South business doing well, studded share doing a lot better as well. The stock had seen a correction. Let's see where it goes from here.
Okay, we'll have to see where it goes from here. Let's take a short break on that note. Up next, we'll focus more on markets and some of these managements will join us for a check on their third quarter numbers. See you in a bit. Welcome back. Sonata Software, like we told you, was trading flat despite a good third quarter performance. The company has bagged large AI and modernization deals in the quarter as well. Samir Dhir, the MD and CEO, joins us now to discuss the performance and what lies ahead. Samir, thanks for being with us here. In your third quarter numbers, there's a bit of a mixed bag when you look at the sectoral contribution. On one hand, you had retail, healthcare grow, despite you telling us previously that tariffs had impacted the retail sector. BFSI continues to come down. Telecom, media, technology also, it stayed soft in the quarter. Now, as you're closing the year, if you could give us a guidance on what the full year FY26 growth would look like and where are the segments where you're continuing to see ramped down by clients?
Yeah, thank you. And thanks for having me. I think overall we had a good quarter. We delivered PAT growth of profit after tax growth of 21.4% Y-on-Y and a sequential growth of 6.1%. So we're very pleased with the performance that in this environment we could deliver 20% plus PAT growth Y-on-Y basis. Our EBITDA outside the one-time exception that we had to take because of the labor code also accreted in the quarter from 17.3% a quarter prior to about 19.5% in this quarter. So I think overall from a profitability perspective, had a very solid, robust performance, and much in line with what we have guided earlier, that we want to be a high teens and a low 20s EBITDA company. So very good with that. On the domestic business as well, I think we had a pretty strong showing. Our gross contribution improved quarter-on-quarter basis 10.8%, which was a concern that we all had given the Microsoft and some of the larger OEMs going direct issue. I think we delivered a seasonally strong quarter on the SITL side as well. And you're right, I think from a AI perspective, we have been making steady progress. I think our order book for the quarter was about 14% of the total order book. So AI order book is increasing in a very healthy manner, which is much in line with our expectations. Now, from a sectoral perspective, clearly we had a large client issue in banking and a large client issue in TMT. So that's why the sectoral performances look good, look not so good on those two sectors, just because of the two specific clients issue we had. And in retail manufacturing, much in line what we have been saying, our tariff have been hitting us. There is some one-time benefit we got in the quarter, but I think going into next quarter, we'll continue to see retail manufacturing will be not growing to the extent that you saw in the current quarter. So yes, overall, very bullish about healthcare business, very bullish about where banking business is, except for one client issue we have. And that's really how the quarter came out for us.
Right. Just for bookkeeping, if you could tell us a couple of things. The TMT, which is technology, media, telecom, HLS, healthcare and life sciences, and retail manufacturing, travel and distribution. How much do they contribute in terms of your current revenue? And what is their contribution in terms of your order book, so that we get a trend on where this is likely to go from here on?
Great question. So healthcare, as you know, healthcare, life sciences and banking financial services are new verticals we created about 3-4 years back. They contribute about 9% of our total business back in 23. They contribute now roughly about 30% of our business together, BFSI and healthcare together. Bulk of our order book, I would say 60 to 70% order book continues to be in these two verticals. And that trend we think is a secular trend that we'll continue to see. TMT, outside the large client, is a smaller book of business. And retail manufacturing, like we mentioned earlier, is under pressure because of the whole tariff situation that is currently going on. It will not, it will probably just hold flat to what you're seeing at this point in time. That's our current expectation.
All right. Samir, what about the AI-led engagements? They're now about 14% of your order book versus 10% is what you told us the quarter before. How do you see this mix rising over the year? What kind of contributions do you see from this segment? And which verticals are driving up the demand for AI?
Great question. So I think we're not surprised with this. We have talked about it earlier. We said in 3 years, we think our AI order book should be around 20-25%. And I think we're getting this sooner than we anticipated, which is nice. I think it's a secular trend that we see across our clients. Their clients are asking us to use AI to deliver time to market faster. So as an example, one of our clients, we're doing work, which is a modernization program. They wanted to move from an older platform to a newer technology, which probably would have taken about 12 to 15 months in prior times. But because our teams could bring in the agentic thinking and the AI thinking into the program, we're able to deliver in about 30 to 40% lesser time than we had anticipated before. Now, the price of the project is still the same, but you're just delivering that in an accelerated manner because the tools exist today to deliver time to market faster. So bulk of the changes in the project that we're seeing in our 14% order book that you mentioned, they're in the realm of delivering customers faster outcomes in a faster timeline basis than really an impact on the top line. That's what we're seeing at this point in time.
I'm tempted to ask you a lot more about EBITDA margin and growth guidance, etc. But since you touched upon AI, just before we let you go, I wanted to understand from a business standpoint, given the sort of conversations around AI, the new developments that are taking place globally as well, for a business like yours, what proportion of your revenue gets impacted by AI in the sense that AI capabilities can do that a lot better than what you are currently offering, or does that? And concomitantly on your cost business, what proportion of AI can reduce your costs? So what the net impact of artificial intelligence could be in terms of replaced and incremental revenue and replaced and incremental costs?
Yeah, so we are a specialist firm in modernization engineering. Generally speaking, we move customers from old technologies to newer platforms. And we do that in a very regulated industry model, which is banking, financial services, healthcare. They're highly regulated industries. There is a lot of premium on data sensitivity. There's a lot of premium on understanding the context of the old code bases and then migrating them to the newer platforms. So at this point in time, candidly, we don't see a significant impact of any of the tools that even got launched last week or even prior, impacting that modernization type of work that we end up doing for our customers. Having said that, it's an area that we are watching. We remain watchful. We do see productivity benefits coming out of AI, much in line with our industry peers, and that's what we're seeing. But in general, the demand from our customers and all the order book that we talked to you about is to go faster, but not cheaper. That's not what we're seeing at this point in time. And because we are largely operating in regulated industry environment, we don't believe the tools that are being launched right now have an impact on those industry segments. If you're doing simple app dev projects, absolutely those projects will get disintermediated. But Sonata's business is far more complex from modernization and regulated industry perspective. So we feel at this point in time, we are moving forward, embracing the changes that are happening in the industry, helping clients deliver faster, but really keeping a watchful eye on the future as well, because this technology still is evolving at this point in time.
Oh, yes. And Samir, we hope to have you back to give us a sense of how this plays out over the coming quarters. Thanks very much for your time here today. Up next, we're going to focus on the bond market. And as always, Manisha Gupta joins in to bring us all of the action from that space. Manisha.
Well, thank you so much for that. When you look at the overall bond markets, and this is on expected lines that we've seen the markets open slightly on a lower side there. This is after the larger than expected bond auction. This was announced after the market hours on Friday. So 14 states will raise nearly 486 billion rupees on Tuesday. This is higher than earlier indicated, 427 billion therein. This is the largest also bond auction that is being seen since the month of March. In the meanwhile, you also have had RBI on Friday issuing a draft regulatory framework. The feedback is sought until the 27th of Feb there. This is on derivatives, on credit indices, and also on total return swaps on corporate bonds. What broadly has been proposed in sense of norms is that one, the non-retail users with a minimum turnover of nearly 10 billion will now be eligible to offer credit derivative products. The proposed norms also show that the settlement basis and market conventions for credit derivative contracts will be specified by the Fixed Income Money Market and Derivative Association of India therein. Also, the market participants may use standard master agreement for credit derivative contracts. It also says that the exchanges may offer standardized single name credit derivative contracts on credit indices with guaranteed settlements. The exchanges also would be allowed to offer futures contract on credit indices with guaranteed settlement therein. FPI participation in futures on credit indices is also something that has been proposed on. And then banks will act as market makers. Also, the market makers would be allowed to offer total return swaps as well. So as of now, all of this is proposed. Remember, this was mentioned in budget. The RBI has been talking about it as well. And finally, we have those proposed framework in public to discuss and to give feedback until 27th of Feb.
All right, Manisha, thanks a lot for that. So that's about the bond market action. Before we slip into that short break, just pull up a couple of these stocks from the broader markets. We have Office, which is up 7.5% right now. Jana SFB, it's the other one, which is up 10%. And Hindustan Aeronautics, after a week which was fairly, volatile for the stock, it has now marginally moved into the green. So we'll monitor how all these defense names play out as well. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Welcome back. It's looking very good from the F&O screen as well. The Nifty is now up 170 points. If you look at the Nifty Bank, a shade better, in the mid-cap index, even better. So the Nifty, 0.2% higher. If you look at the Nifty Bank, it's obviously 0.9% higher, almost 1%. In the mid-cap index, 1.25%. All of them progressively seeing bigger gains, and that's the sign of a positive bull setup for the market. If you look at the advanced decline ratio as well, over 2,200 stocks in the green and a much smaller number in the red. And the good part is all of that is nearly earnings explained or earnings led. So you look at some of the big gainers, right from SBI to Kalyan Jewellers to something like even a Crompton. Crompton is halved from the top, and decent inline performance coming in, and the street looks at the stock as it's fairly attractive, and it's up around 4.5%. on an inline set of numbers as well. Kalyan Jewellers too. The results were good. The street knew about that, but the stock had fallen about 40% from the highs. And SBI continues to wow the street on the way up with its contribution to both the Nifty as well as the Nifty Bank. What this has done is it's given bulls the gumption to go ahead and sell those puts. So we have 25,800 put and the 25,700 put. Both of them fairly well written in today's trading session. Tells you that the support for the market has now moved higher. Remember, this pre-budget or pre-India-US deal was close to around 24,750, 24,800, then moved higher to around 25,300, 25,400, and now it looks like the support has moved higher structurally to 25,550 to 25,700. That's exactly what the put writing is indicating. Though on the way up, we still have unfinished business at around that 26,000 mark, which is why there is a fair amount of writing at the 26,000 call as well. For now, the Nifty is comfortably above the 50-day moving average, so now that becomes an important support to track as we move forward technically, and closing above this would perhaps give us more confidence to go beyond that 26,000 mark once again. A lot of long positions added on the banking space, so we have IndusInd Bank, which is fairly well bid, and Bank of India as well. A lot of long positions added out there. All in all, a good setup if you're a bull.
It's a very good setup if you're a bull indeed, Manglam, and thanks for setting that up for us. It's a good time to invite Nagraj Shetty, Senior Technical Research Analyst at HDFC Security, to give us his thoughts. Nagraj, thanks very much for being here. Your trade on the Nifty finally looking good from here, and any specific stocks that you would like to highlight for us?
Hi, good morning. Yes, Nifty has been in a strong uptrend, no doubt about that. After an eventful week of last week and a big, huge opening upside gap formation of 3rd February, the market has stood higher and the overall chart pattern is looking very positive for the market. The gap that was formed on 3rd February is indicating a bullish break, a bullish runaway gap. Normally, technically, we believe such a gap formation during the uptrend, and we expect we are in the middle of the uptrend and more upside is likely to come. From here onwards, I'm expecting 26,000 and 26,350 are going to be the two extremes for the market, hurdles for the market in the near term. I have two stocks from a broader market perspective, from a mid-cap, small-cap segments. First one is Castrol India. The stock price has been in a continuous downtrend over the last many months. The low top, low bottoms that indicates on the chart is signaling the stock was in a consolidation phase. Recently, it has moved up very well from the lower levels, indicating a formation of important bottom reversal. Currently trading around 189, one can look to buy at this point of time. The immediate target would be around 210, and one can place a stop loss at 180. Second one is the Heritage Food. This stock, after consolidation, has bounced back very well from the low levels. Looks like an important bottom formation at this point of time. Currently trading around 380.50. One can look to buy at this point of time. And immediate target would be around 400. One can place a stop loss at 370.
All right, Nagraj, thank you so much for that. Heritage Foods up around 4.5% at the high point as we speak. We'll take a short break on that note, come back, get you more on individual stock sectors, a lot of analysis. Gaurav joins in with some important updates as well. Stay with us.
Okay, pull up the PSU Bank Index, doing very well in trade now, up about 3.2% as we speak, led of course by the star of the show, State Bank of India. That has delivered a very strong third quarter numbers that seems to have enthused the street, and along with it, it's lifting other names like Indian Bank, Bank of India, Central Bank and others. But there's another factor why some of these PSB names are buzzing in news today, and that is because of RBI coming out with this new draft on a risk-based premium framework for deposit insurance payments. Simply put, earlier all the banks were paying a flat fee for deposit insurance, but now the riskier banks will pay more and the less risky banks will pay less. Gaurav joins in to explain the impact of this on the some of the banking names. Gaurav.
Well, yes, if you look at the news flow, what is happening right now is that the DICGC, which is Deposit Insurance and Credit Guarantee Corporation, they have cut their rates from flat, as what we have seen since 1962, to a risk-based model. Now, what it's going to happen is that they're going to categorize banks in 4 categories, A, B, C, and D. And at the same time, the rates will differ for all the categories. Apart from that, they have also added another layer, which is the vintage category. That will be a discount given to banks who have track record of more than 25 years, and that discount could be as high as 25%. So let's understand how it is going to work. Earlier, banks used to pay 12 paisa for per 100 rupees of deposit guarantee insurance, and now let's say if the bank falls under A category, they will be paying 8 paisa instead of 12 paisa, which is 33.3% discount to the current rate. And at the same time, let's say if this bank also falls under the vintage category, they will have additional 25% discount, meaning that the effective discount rate will be as high as 45% for the bank. Remember, now if you look at the impact, earlier we have seen some of the banks reporting this as a percentage of OPEX. So we have banks like HDFC Bank, ICICI Bank, SBI, all of them who reported this cost as high as 4.5% of their total OPEX. And at the same time, we have PSUs like Bob and Canara who reported this cost to be as around 6% of their total OPEX. Now there will be some benefit here as the cost of this insurance will go down, OPEX will decline, and as a result, analysts believe that this will bring in cost saving as high as 1.5 to 3% in terms of OPEX, 1 to 2% benefit in terms of profit, increase in profit, and this will also translate into as high as 4 basis point of increase in the ROAs. Remember, analysts believe that PSU banks will have a higher impact here because of the OPEX cost that is higher for PSU banks in terms of the deposit insurance. So all in all, a positive news for all the banks, specifically for PSU banks, and that is what is playing out as well. As we speak, the PSU banks index is up more than 3%.
Take that point, Gaurav. Thanks a lot for that. We'll get a little more into this. But meanwhile, while Gaurav was speaking, there was news that flashed at the bottom of your screen coming in from our colleagues at Money Control Pro, which is where Kalyan Jewellers actually has reached out to the SEBI, and they are seeking exclusion from trading of contracts in the F&O space, and that's largely because they allege some sort of market manipulation. Just to put things into perspective, Kalyan Jewellers was introduced in F&O in the December series last year. At that time, the share price was closer to around 750 rupees. In the next subsequent Jan series itself, the stock fell within 15-16 trading sessions from over 700 rupees to around 400 rupees. So there was this big decline that happened, which the company says is largely led by a concentrated sort of attack for which there needs to be an inquiry. And until that inquiry is completed, maybe they need some sort of, exclusion from trade in F&O. And that's something we will monitor. The stock even now is down 40% from its highs, despite good results that have come by. But let's go back to the story that Gaurav was speaking about. Earlier, we caught up with Santanu Chakraborty of BFSI BNP Paribas, who shares how beneficial the new RBI rules would be for the financiers.
In terms of stability of the banking sector, one of the most far-reaching impact policy points has been this deposit insurance. I mean, we have had across a set of banks in the last 5-7 years situations where people were afraid that deposit runs are going to happen and this and that, but nothing of the sort has happened. In one case, rescues have been organized, bringing in other banks and so on and so forth. This innovation now introduces is that underwriting is not at equivalent cost to all concerned, and there is now incentive for you to manage your own liquidity risks and your capital position in a way so that you can get cheaper insurance. So it introduces an element of meritocracy into the system, and as is the want in most such measures, obviously it is the stronger franchises which benefit on an affine basis, on an immediate basis.
All right, with that, we'll take a short break, come back on the other side, a big story where we get you excerpts of our conversation with Piyush Goyal and also decode the impact of the India-US trade deal.
Well, in an exclusive interview with CNBC-TV18, Commerce and Industry Minister Piyush Goyal announced that Donald Trump's executive order reducing tariffs on Indian exports can take effect this week before the official signing of the trade deal. The minister also spoke about India's Russian oil imports and other fine print of the India-US interim trade deal. Take a look.
I would suspect any day during this week the executive order to reduce tariffs to 18% should be coming out.
Right. So does this mean that with that executive order, the rate would immediately come down to 18% in the Federal Reserve?
Right.
Would it require a signing?
It would require a signing by the Honorable President of the United States of America. But now having entered into the framework agreement and all terms being finalized, I see no difficulty in that.
Right. So are you also expecting a visit from the United States to somehow jointly announce this deal, or are you going to US?
We will have our teams now put the entire documentation in legal format so that we can sign the interim trade agreement or the first tranche of the bilateral trade agreement, for which I have invited the USTR, the United States Trade Representative, my good friend, Ambassador Jameson Greer, to visit India. He has indicated that he would accept the invitation, and maybe mid-March sometimes he would be visiting India.
All right. So for exporters, for Indian exporters, that would be the date possibly when the new tariffs would become effective.
The 18% would become effective immediately. There are other areas of concessions, some areas where we've got a zero reciprocal tariff. Those will become effective after the execution of the interim agreement.
Right. Now, over the last 1 year, there was uncertainty about the trade deal, and that was impacting investor sentiment towards India. The stock market sentiment also was impacted to some extent. What would be your expectation now?
Well, Indian economy powers on. It is the fastest growing large economy. Companies are reporting huge demand. January performance numbers should come out quite well in terms of the volumes. Recently, I was told steel mills are working at full capacity. I was told auto stocks are all sold out. There's no inventory at the dealers' end. Cement stocks were down to just about under a week or a few days. I mean, the indications which I have received from the market sources or public from industry, which clearly reflects that there's a good amount of enthusiasm in the marketplace. The execution and finalization of the EU trade deal coupled with the US trade deal coming in quick succession of each other, I am sure will give a big fillip to the India growth story.
All right. Now, as far as the concessional rate of 18% is concerned, what would be the volume of the goods? If we ask you to quantify that, what volume of Indian exports going to the US will be now subject to a lower 18% tariff?
First of all, there are many goods which will get zero duty tariff. Some are already going at zero duty, some more will come at zero duty. In the aggregate, my sense is about half the exports will become zero duty, zero reciprocal duty in terms of tariffs. On the other half, almost 10 or 15% would probably be sectoral tariffs, which for steel, aluminium, and products and derivatives of that, in some cases could be as high as 50%. But then they'll have to look at how much is the steel or aluminium content, and accordingly it will be a calibrated or a calculated import duty as a Section 232 tariff, not as a reciprocal tariff. Everything else will be at 18%.
You spoke about agriculture, and you've said that India's red lines have been protected.
Totally.
But at the same time, you've got farmer groups who have expressed concern, and they've said that this is a total surrender, and they've also called for a protest on the 12th of February. How would you address their concerns?
I will be talking to the farmer groups or any associations. I would recommend to them also to carefully have a look at the exempt list, which I have spoken about on earlier occasions. All the areas of mass production where we are self-sufficient and which really the larger part of farmers are producing, like meat, poultry, all dairy items, rice, wheat, sugar, all types of GM products, soya meal. We have corn, maize, millets like jawar, ragi, bajra, kodo, amaranth, fruits like banana, strawberry, cherries, citrus fruits, some pulses like green pea, kabuli chana, moong, oil seeds, certain animal feed, groundnuts, honey, malt and its extracts, non-alcoholic beverages, flour and meals, starch, essential oils, ethanol for fuel, tobacco, all of them are not covered under this agreement. They have been excluded, and the farmers are completely protected from any sort of imports with the high import duties that we impose on them. So I really think the farmers have nothing to worry. It is a few political vested interests or naysayers who are misguiding them. And I would like to appeal to all farmers and farmer organizations to carefully assess, and they will find that our farmers are fully protected.
You know, one of the points that the Bharatiya Kisan Sangh has raised, that the dried distillers grain, now that has, you know, a GM component to it. They've also raised concern about soybean oil as well. How would you address them? Because they're seeking a clarification.
Soybean oil has been imported, as has DDGS on earlier occasions, but soybean oil is imported every year in very large volumes from all over the world, including from the US. So it's not as if it's something new. The environmental protection norms are that once the product is processed, then GM does not come into play. So I will allay their concerns with full responsibility, that they need not worry. No GM products are being given entry into India.
Right. Now, there was a line in the joint statement which says that India will reduce or eliminate tariffs on all US industrial goods and agricultural products, including dried distilled grain, red sorghum, tree nuts, fresh and processed fruits, soybean oil, wines and spirits, and additional products. Now, what does the additional products mean? Is there room to include more?
There's a vast range of agri-products, many of which are, you know, of a certain type and names that we've never even heard of them. There's not much trade internationally or between India and any other country. Agriculture has a very long list of items, but these are the main agri items, what I just read out to you. What we've opened are items which we are already dependent on imports. For example, we import almonds, not today, but for decades. As children, we have eaten California almonds. We import pistachios, we import walnuts in the country. So these are certain products which for a long period of time have been imported. You are well aware that the demand for apples in India far exceeds the production. So we import about 5.5 lakh tons of apple every year. A lot of them come from the United States of America. We have given them a quota which is less than what they are currently exporting to India. And even within that, while the normal floor at which we allow imports is 50 rupees as a minimum import price, on which 25 rupees is the duty, so 75 rupees as a landed cost. With the US, the apples being of a certain higher quality, a minimum import price of 80 rupees has been kept with a 20 rupees duty. So the floor actually is 33% more than the normal apple, which is a huge protection for Indian farmers. So I would think that we have not left any cause of concern and ensured that farmers in India are fully protected.
Right. You know, speaking about the executive order, which was issued almost simultaneously by the White House along with the joint statement, it said that India has committed to stop directly or indirectly importing Russian oil and will purchase products from the United States. Could you give us a sense of what's the understanding? Because our Russian oil purchases have been coming down.
This is a subject that doesn't get included in the trade deal, nor do I handle it. I think it would best be answered by the Foreign Office, who have already made certain clarifications in this regard.
Right. I'll just persist for one more moment because the executive order also speaks about monitoring mechanisms, and it makes the elimination of the 25% ad valorem duty contingent on stopping purchase of Russian oil. So how are we going to handle this? Because the US will be monitoring whether we are buying directly or
I
indirectly.
think this is best answered by the Foreign Office because I wouldn't know exactly what they mean by this comment and whether any discussions have been held.
All right, so that was the exhaustive and extensive interview that we had with Piyush Goyal. But whether this has any impact and what kind of impact, the quantum of that, Vinny is standing by to tell us the detail on that one as well. Vinny.
Hi, yes. So in terms of impact that comes in, export companies surely are going to be in focus. So when you look at the sectors, we'll see textile, chemicals, autos, seafood, that's shrimp manufacturers, jewelry side as well as solar companies are the sectors which see an impact. Now, in terms of textiles, obviously, Gokuldas Export, Welspun Living, Indocount Industries have more than around 65 to 70% exposure. That comes into the US markets. Apart from that, Pearl Global, Arvind Limited, KPR Mills are some of the other names also that have a good exposure in the US. And obviously, this increases the TAM of the companies and obviously gets back the margins which they've lost in the last couple of quarters. Chemical companies, so SRF, PI Industries, Aarti Industries, all of them in focus as well as Indian chemical exporters. Exports to the US are around 20% of the total exports, which are valued around $6 billion. So obviously, it comes in as a positive for them as well. Auto companies and auto ancillary companies, as auto companies, they get an exemption under 232. So in further details, obviously Tata Motors, 33% comes in of JLR volume comes in from the US market. Sona BLW has around 40% exposure to the US. Bharat Forge, Balkrishna Industries as well as Eicher Motors also have some bit of an exposure in the US market, so it'll turn out to be positive for them. Shrimp companies or seafood companies, Apex Frozen, Coastal Corp, Avanti Feeds, all of them in focus, as US is one of the important markets for India for exporting over there, so a big positive for them. And solar companies, keep an eye out on Vari Energies. They have around 30% exposure to the US. MV, photovoltaic power, as well as Vikram Solar are something that we're keeping an eye out on.
All right, Vinny, thanks very much for taking us through that exhaustive list on the impact from the India-US interim trade framework. On that note, Mangalam and I are going to take your leave. Thanks very much for tuning in. But stay with us. Halftime Report is going to take all of the action forward.